Thank you, Kevin. Well, let me tell you, first of all, if any of you were here last year and heard me speak, you can check your emails, go for a bathroom break or whatever, because what I'm about to tell you is very similar to last year. Investors still love Boston, and nothing's going to change on that front. We're talking about the human capital and the colleges. That's not changing. The stability of education, the finance sector, healthcare, and obviously what we heard already, how much the life sciences have been growing, particularly in Cambridge and the like. 2015 overall sales volume, $10 billion, which is still, by the way, a third less than our peak in 2007. As you can see that graph with that really, really high peak, that's 2007. So we're not even close to that. That's down a bit over from 2014, but we're still much, much higher than the average between 2011 and 2013. Some of the key stats we can talk about: average sales price, $265 a square foot. That's all sales above $5 million. 15% higher than we were in 2007 at its peak, and it's 10% higher than last year. One interesting data point that I thought we should look at for sure is we always talk about foreign capital, but you look back 10 years, 2004 to 2005, there was about $1.4 billion of investment in foreign capital. And now we look at today, 2014, 2015 combined, $7.2 billion. That's a 419% increase. So you really talk about the change in that area. Obviously there's the concern why. It's safety. They look at Boston as being safe. When I talked about before those different components, the capital, human capital, you talk about the sectors and the stability. And frankly, the foreign capital, they have patience. They'll hold on for a long time, and they have lots of capital to put out here. We hear that all the time, not just from Asia, but from all over the world. Here's another thing that I found was interesting too. You look at 2004, 2005, and some of the big buyers back then. You had Beacon Capital, of course, Boston grown. American Realty Financial, and which doesn't exist anymore, and Prudential Real Estate. Then you look at today, you talk about Oxford from Canada, Norges Bank, and NTT, all foreign capital just pouring in. So, Boston, here we go, a really, really success story. You talk about the Boston area and what's going on, and all the investors are really been doing really well in the last couple of years. So here's just an example of some Class A properties that have traded. We've already talked a little bit about 500 Boylston Street and 222 Berkeley Street. $1.3 billion purchase, again, Oxford. One Channel Center trading for $316 million, which is 100% leased by State Street Bank. That also, by the way, just so you know, that $316 million number includes a 900-car parking garage. So it's about, I think it was about $65 million for that component of it. Oh, excuse me, $55 million, maybe that was. And then thirdly, we talk about the $359 million land purchase in Seaport, just really underscoring what people think of the Seaport, with all that development potential. Class B sales, a lot more of those have happened than in A buildings in the last year, but just nonetheless, just as interesting. 50 P.O. Square was acquired by CalSTRS, which was an 87.5% interest, condominium interest, of $471 a square foot. You talk about Thompson Place in the Four Point Channel area, $454 a square foot purchased by Invesco. And then we have an off-market transaction here by J.P. Morgan over at 711 Atlantic Ave for $432 a square foot right across from South Station. So now we move out to the suburbs where there's a little more, not as successful. Not that it's not, it has lots of success in certain places, but just not as uniform as we talk about with Boston. So first and foremost, we talk about the fact that it's a bifurcated market. Central 128, that's where it's strong, that's where all the activity is. If you looked at some of these development projects that we've been talking about prior, University Stations and up in Burlington and such, and in Waltham, that's where it's all happening. Out in 495, still pretty soft in other places. Buyers that are not able to compete in the Boston areas and all these other really hot and dynamic markets, they're still looking to put money out as well. So they've pushed out further. They're pursuing better yielding assets. 4 to 5 caps closer in becomes 6 to 9 caps when you get further out. And the question is you're able to sustain that, sustain those yields, and then be able to make a lot more just from purely the cash yield in hopes that you have a better value. There has been increasing in value in the areas out there, 20% increase year over year. So there are more investors looking to do more out there and try to find what they consider value and opportunity. So a couple of interesting things I found out in the suburbs, the idea of buying wholesale and selling retail, real big surprise, right? But it's happened in large scale here. There were 2 big portfolios that traded this past year. Equity Commonwealth spun off a $376 million portfolio, of which 629,000 square feet of it was in the Boston market. And then also Columbia Property Trust, which was a Wells REIT spinoff from years ago, sold off $433 million in their portfolio, and 706,000 square feet of it was in this market. Both of those portfolios acquired by Lone Star funds. So their way of trying to make money in the suburbs. Some recent sales we can talk about. We talk about 53 South Ave in Burlington. Arthur Gutierrez sold that property. That was the long-term build-to-suit with Keurig for $427 a square foot. Prospect Hill, a Big B campus acquired by Anchorline, who's obviously been very, very active in the last couple of years. And then 150 Royale Street in Canton, acquired by Jumbo Capital Management. Lastly, we move over to the industrial market. And very much like last year, or the prior year, I should say, it was a very constrained market. Boston's clearly not a location for the perspective of industrial warehousing and such like you talk about in Chicago and Dallas and Southern California and such, but it's still here and it's still needed. It's a constrained market. There's a lot of demand for it, and there are a lot of buyers for the product. What's ended up happening was the lack of A properties available has a lot of folks chasing B properties, and B properties have become very, very hot. And also, when people get priced out for that, they've been stretching out and looking at flex product. Flex product wasn't as much in demand a few years ago, mainly because people were concerned about tenant improvement costs and such being much more than in warehouses. But frankly, flex product, there's a lot more yield you can achieve today for that. So here we go with some sales in the industrial market. 112 Barnum Road in Devens. I picked this one I thought was pretty interesting because this was the old Evergreen solar facility. $400 to $500 million was spent on it, including equipment. And then they went bankrupt, and it sold to Colliers Properties for $8.5 million. 3 years prior to them harvesting this one for $36 million. So in fairness, they put money into it, but they still made a lot of money on that one. 675 Canton Street in Westwood. Colony Realty Partners just acquired that for $79 a square foot. And what's interesting about that is that Prologis has been obviously dialing down everything in this market. They only have a few assets left after liquidating, and this was one of the last assets. There's only about 2 more left. And then thirdly, we have Colony's portfolio that was sold this year. 5 buildings, 4 different locations, B, industrial, warehouse, pure warehouse. Functional, very functional though, and well leased. It was full. And that was very hotly contested amongst a number of folks. And there's probably some folks of you out there that were very unhappy with us when we sold that. So, at the end of this, I'd probably just say, again, what I said last year. When you're downtown, you have to be disciplined. It's a lot of pricing increases in the last few years per square foot, a lot of rent increase, but the global urbanization trend is not changing. So if you were patient long-term, it's going to be a great investment long-term for sure. Suburbs, be selective about products and location, and you'd have to understand that there's opportunities. The market is healing out there. It's just not as fast as everything we hear about the dynamic nature of downtown. And industrial, I would buy any functional, well-leased assets. And even with vacancy, the promise of being able to lease because there aren't a lot of new buildings around or coming online anytime soon for industrial, there's a lot of opportunity and there's a lot of demand for that as well. Well, thank you very much. And I'll turn this back over to Tom.